First of all, thank you for welcoming me and OECD for this momentous occasion to witness the launch of Global Investor Forum on Climate Change. I'm particularly happy, personally, to return to this extraordinary city and join the discussion about investment on green infrastructure, for example. Because recent weeks, everyone, not only in Paris, but in Tokyo, in New York, everyone asks me about Japanese economic policy package and financial market developments in Tokyo. I feel a bit tired with this kind of discussion, so I feel so fresh in discussing green issues. Also, I have been so much impressed with the quality and relevance of the discussion so far today. My duty is to close the discussion of today, but I try to bridge today's discussion, tomorrow's discussion, by referring to broadly on institutional investors' role as Wilcome kindly mentioned in the OECD, and also the policy tools to provide institutional or other investors to make a long-term investment, particularly on green infrastructure, which is one of the main issues to be discussed tomorrow. We know that infrastructure investment needs for greening growth are already significant and will continue to rise in coming years. Our latest analysis suggests global infrastructure investment requirements may be in the order of $50 trillion into 2030, or in terms of annual flow, it is roughly $3 trillion per year. Today, only roughly $1 trillion annually is estimated to be invested in infrastructure through domestic and foreign investments, public and private channels, leaving about 3-1, $2 trillion investment gap. Asia is characterized by a rapid pace of economic growth and urbanization. Infrastructure needs are more acute in Asia in this area than any other region in the world. At the same time, the large populations of emerging Asia who lives in vulnerable coastal cities, including this particular city, are likely to suffer disproportionately from the adverse impact of the climate change. The choices we made today about infrastructure investment are critical to meet the climate change challenges. If we make the wrong choice today, we will lock in high carbon infrastructure system and development patterns that are also vulnerable to the impacts of climate change. There is an opportunity and an urgency to be right, not just to build more, to make a right infrastructure investment, not only more. In the face of infrastructure investment needs, and given the current fiscal state of many economies, public finance, engaging the private sector will be particularly critical to fill the infrastructure investment gap, $2 trillion per year. To this end, governments have a role to mobilize private investment towards low carbon and climate resilient infrastructure. Bank lending, one of the traditional private sources of financing, is under major constraints due to post-crisis deleveraging, financial turbulence, and new banking regulations in Basel. Corporates and utilities are also under quite serious balance sheet pressure. Institutional investors now manage $75 trillion in assets in the OECD member countries. Given the current low interest rate and weak economic growth prospects in many OECD countries, institutional investors are increasingly looking for new asset classes. Their investments in green infrastructure can be a win-win scenario, where I I say institutional investors, including mutual fund, pension funds, insurance companies, and sovereign wealth funds. Infrastructure investment can have the kind of characteristic that are attractive to long-term investors, like steady, long-term, inflation-linked income streams with low correlation to the return of other investments. A recent investment industry survey identified in Europe, over 50% of installed wind turbines are now owned by institutional investors, more than 50%. However, our institution OECD analysis shows their overall asset allocation to direct infrastructure investment in general remains very small, less than 1% for OECD pension funds, for example. And the green part, green investment component, remains even more limited. The role of the OECD is to provide governments with evidence-based policy analysis and recommendations to assist them to design better policies and approaches to support long-term financing for green infrastructure. As such, we have been working on how to create and enabling conditions to shift and scale up institutional investors' investment in green infrastructure. Building on two recent reports on the role of institutional investors in green financing, the OECD is now developing policy guidance based on a set of case studies of specific green deals, examining carefully what elements came together in these transactions to create an enabling environment for investment, and what role government policies played. Our study suggests there are some important opportunities for institutional investors to derive the returns they need from green investment if these deals are properly structured. This if is a quite important one, particularly for policymakers. In order to deliver the necessary risk-adjusted returns, the right policy framework will need to be put in place. We find allocation to direct green infrastructure investment remains small for a range of reasons, notably due to regulation and policy uncertainty, market failure, a lack of suitable financing vehicle, and investor inexperience with direct investing, and with new technologies and asset classes. Many sectors of green infrastructure are regulated markets. Therefore, there will be regulatory risks. Investors can handle certain types of regulatory risks, but they cannot handle sudden or even retroactive changes, which are particularly corrosive. The policy framework may be changed as necessary, but it needs to be done with regulatory clarity, transparency, advance notice, and with engagement with the key stakeholders. It was shared by the previous panel as well. All investors need to make risk-adjusted returns until the playing field is leveled for low-carbon technologies. Many will still be less profitable and more risky and policy-dependent than conventional technologies. Of course, institutional investors cannot be viewed as a single entity with identical characteristics. The economic geography of institutional investors is quite important. Institutional investors range from, for example, 10-person pension plans to global life insurance companies with assets under management in the hundreds of billions of dollars. Furthermore, there are wide differences between how institutional investors can participate through indirect corporate investment via stocks and bonds, through direct project investments, or through funds or vehicles as a bridge. In designing policies, government needs to consider the specific role of different types of institutional investors. the priority channels through which investment could most usefully be scaled up, and at which stage of the financing value chain the investors may participate. Putting a price on carbon and other pollution is critical to establishing the clear policy framework to support clean investment. An important first step is taking out subsidies to fossil fuels. Our latest estimates show the OECD countries even support the production and use of fossil fuel by an overall value of about $55 to $90 billion per year. $55 to $90 billion per year. Our sister institution, IEA, calculate emerging and developing economies provided subsidies to fossil fuel consumption of about $523 billion 2 years ago in 2012. I repeat, $523 billion 2 years ago. This provides an incentive to emit carbon oxide that is an equivalent to $110 per ton. Recent analysis shows the phasing out of these consumption subsidies could reduce greenhouse gas emissions by 6% globally in 2050, compared with business as usual scenario, while increasing GDP growth in most of the countries implementing these kind of reform of removing subsidies. Economic instruments, such as putting a price on pollution and resource taxation, are fundamental to helping to drive private sector investments towards greener alternatives. They are a cost-effective approach to managing pollution and effective resource use, and they provide incentive for innovation in products and technologies. They are a core element in the toolkit for green growth. For example, not quite a new example, but we found when Sweden introduced a tax to reduce NOx, nitrous oxide pollution, in 1992, some 20 years ago. It led to a one-third reduction in emissions after just 2 years. The tax on NOx emission provided flexibility for firms to find least cost solutions, and as a result, it led to the emergence of new technical solutions. This was reflected by the large number of related patents taken out by Swedish companies following the introduction of this particular tax. Today's discussion among such a distinguished group of business and group of people engaged in real projects and businesses was quite valuable and important in considering how to scale up private finance for green growth. Particularly, this afternoon's session focused on how to manage risk and opportunity for green investment and how market-based mechanisms can drive low-carbon and sustainable business projects. This is particularly relevant. The discussion has strong bearings for our monitoring of barriers to institutional investors' investment. One issue preventing institutional investors from further allocating to infrastructure investment is the lack of appropriate investment vehicle. Only the target largest investors has the capacity to invest directly in projects. Smaller investors, in particular, require pooled investment vehicle. There is also a lack of debt instruments such as bonds, as we discussed, for institutional investors to access infrastructure investments. This is notable because bonds remain the dominant asset class in portfolio allocation of pension funds, 50% of their total assets, and the insurance company, 61% of their total assets across OECD member countries. Other important issues touched upon today include the short-term investment horizons and liquidity requirements, which preclude some investors, particularly an insurance company, from entering into illiquid assets with long-term investment horizons. Smaller investors may also find it difficult to justify building the team specifically targeting direct investment within their organizations. It is quite easy to guess such kind of difficulties. Scale can be a factor both on the investor side and on the deal side as well. Government have a key role to play in shaping the general regulatory and investment policy environment to facilitate long-term green investments by coordinating with forward-thinking asset allocators such as you here today. At OECD, we are helping governments identify the policies that can harness the growing interest of private investors to support greener growth. In order to facilitate the engagement of private investors in green projects, the promotion of public-private dialogue on green investments will be a key element, I believe. A close dialogue between investors, the financial industry, and the public sector will help to understand the barriers to investors allocating to green projects and to better understand how to surmount them. In this respect, the Green Growth Action Alliance is a significant step towards strengthening collaboration between business, governments, and society, and the international organization as well, in overcoming barriers to and securing the benefits of green growth. We are always willing to play a part in assisting such a dialogue. I thank you for your attention at the end of such a long day, and I'd like to propose, Alexandra, if possible, to raise the room temperature by 2 or 3 degrees tomorrow's discussion. Thank you very much.